Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 4 from Corporations, Partnerships, Estates, and Trusts, which covers corporations, organization, and capital structure. So by the end of this chapter, you should be able to explain the tax consequences of incorporating a business, identify the basis issues relevant to the shareholder in the corporation, determine the consequences when corporations assume shareholder liabilities, explain the tax aspects of the capital structure of a corporation, describe the tax differences between debt and equity investments, determine the tax treatment of shareholder debt and stock gains and losses, identify tax planning opportunities associated with organizing and financing a corporation. So with this chapter, we're essentially dealing with the four principal areas fundamental to working with corporations, as was covered in chapters 2 and 3. We understood the treatment that applies to entities treated as corporations for federal income tax purposes, recognized specific income tax rules that apply only to corporations. And lastly, in chapters 2 and 3, we identified filing and reporting procedures and considering special situations involving corporations. So in this chapter, we continue this approach and we address some of the issues involving corporate formation, capital structure, and special rules for investors in a corporation. And some of them includes tax consequences to the shareholders in the corporation when shareholders transfer property to form a new corporation, the tax result when shareholders transfer property to an already existing corporation, capital structure of a corporation, including equity and debt financing, special tax treatment afforded to certain corporate investor gains and losses, and lastly, special treatment given to gain realized from the disposition of qualified small business stock. So Unit 1 covers the organization of and transfers to controlled corporations. So property transactions, they normally result in a recognized gain or loss whenever a taxpayer realizes gain or loss. So simply stated, let's say someone owns a building, they purchased it for $100,000 and they sell this building for $150,000. The transaction has taken place and they now have a gain of $50,000. $150,000, which represents the sale price, and $100,000, which represents the basis, the cost of the building. So there's a $50,000 realized gain. So as a result of this, there's a special provision in the code that applies whenever there's a transfer of property to a corporation in exchange for stock is a taxable transaction. So realized and recognized gain or loss equals the difference between the fair market value of the stock and any other assets the shareholder receives and the tax basis of the property that the shareholder transfers to the corporation. But there's non-recognition of gain or loss in limited circumstances. So this introduces what's called Section 351. So in contrast to the typical result of gain or loss recognition, the code permits non-recognition or gain or loss in certain circumstances. So there's what's called Section 1031, where there's a like-kind exchange, and Section 351, which we are going to now cover, which deals with the transfer of property to controlled corporations. And what this means is that you do not, not recognize gain. What happens is that it is deferred. You get to postpone the recognition of gain or loss until there's a substantive change in the taxpayer's investment, right? So here's why there's this Section 351. So the three reasons are as follows. The owner's economic status has not changed. So think back to the example that I mentioned previously with the individual who paid $100,000 for a building. And let's say the value appreciated to $150,000. Imagine how unfair the tax law would be if you were required to pay taxes on the appreciation of value. You didn't sell the property. You do not have the wherewithal to pay. So therefore, the same thing essentially happens. Let's say this individual, they own the $100,000 business, and all they simply do is they transfer the property into a corporation. There was no sale that took place, and the ownership is basically, for the most part, still the same. They own the building before the corporation, and now they own 100% in the corporation. Let's just, use it to make it easy. They own 100% in the corporation. So therefore, there was no change in the substance of the building. The owner was the owner before, and after it was transferred to the corporation, the owner is still the owner after, because again, they own 100% of the corporation. So in addition, the shareholder lacks the cash to pay a tax on any realized gain. This is governed by the wherewithal to pay concept. As mentioned, they didn't sell the property for $150,000, so they do not have that $50,000. And the taxpayer's choice of entity for conducting business should not be compromised by tax rules. So with the corporate formation transaction, again, the shareholders, they contribute either cash or property to the corporation, and the corporation, on the other hand, issues stock to the shareholder. So the control that is required under Section 351 is 80%. So that's the key thing. As we are looking at Section 351, there's a few key things that must be considered. The first is that there must be a transfer of property. The third is that they must control the company. They must be in control, and that control is 80% after the transfer. And lastly, they must have transferred the property for stock. So in the event that, let's just say, they receive stock and they also receive cash, or they also receive the building, in situations like that, that is called a boot. And then the shareholder will be required to report a portion of the realized gain or loss. So just keep that in mind. So here we see a formation example. And here, Ron, he's considering incorporating his sole proprietorship to obtain the limited liability of the corporate form. So, but he realizes that if he incorporates that, he'll be personally liable for the debts that he takes on. So here we look at this information. We see the tax basis. There's $10,000 in cash. The fair market value is $10,000. There's furniture and buildings with a tax basis of $20,000. The fair market value is $60,000. There's land and building with a tax basis of $240,000 and a fair market value of $300,000. So the total of the tax basis for the cash, furniture and fixtures, land and building is $270,000. And then from there, the fair market value is $370,000 in total. So Ron will receive $370,000 in corporate stock in exchange for the assets he transfers. So without Section 351, he recognizes a gain of $100,000. The cost basis of $270,000 versus the fair market value. So without the Section 351, he would recognize a gain of $100,000. But with Section 351, there's no gain or loss. Why? Because again, Ron's economic status, there was no change, right? He did not sell the furniture and fixtures. He did not sell the land and building. The cash was his, and now it's in the name of the corporation, which he owns 100%. So technically, the cash is still his. So there are some consequences of Section 351. So with Section 351, in general, there's no gain or loss to transferors on transfer of property to corporation. All right, so it's very important to decipher what is property. So the definition of property for Section 351 purposes is broad. So for example, along with plant and equipment, cash, intangible assets like unrealized receivables of a cash basis taxpayer, installment notes, those are also considered property. Code Section 351 specifically excludes services from the definition of property. So a taxpayer must always report as income the fair market value of stock and any other consideration as compensation for services. So just keep that in mind. So whenever a taxpayer receives stock as consideration for rendering services to the corporation, the income that the taxpayer recognizes is equal to the fair market value of the stock received. The next requirement is that it must be in exchange for stock. So non-recognition of gain occurs only when shareholders receive stock. So stock includes common and most preferred shares. However, it does not include non-qualified preferred stock because it possesses similar attributes of debt, right? In addition, regulations state that the term stock does not include stock rights and stock warrants. So otherwise, the term stock generally needs no clarification. So as a result, if there's any corporate debt or securities that's received, those are treated as boot because, again, they are not considered stock. So in the event that a shareholder receives corporate debt in exchange for the transfer of their appreciated property to a controlled corporation, they recognize gain if the shareholder realizes a gain on the contribution. And then the last requirement is if immediately after the transfer, the transferors are in control. So in order for a transaction to qualify as non-taxable under Section 351, the property transferors must control the corporation immediately after the exchange. So specifically, the property transferors must own stock possessing at least 80% of the total combined voting power of all classes of stock that's entitled to vote, and at least 80% of the total number of shares of all other classes of stock. So as mentioned, if there's boot, if they receive anything other than cash or stock that's received by the transferors, in such case, gain is recognized up to the lesser of the boot received or the realized gain, and there's no loss recognized. So we're just going to go over some of the three basics as we just, or the three requirements rather, as we just discussed. Property defined. Definition of property for Section 351, it's broad. It includes cash, obviously, plant, property, equipment, any proprietary processes and formulas, any proprietary information, any unrealized accounts receivable for cash basis taxpayer installment notes. But as mentioned, Section 351 specifically excludes services from the definition of property, but we will learn a little later that there is a caveat when an individual, a shareholder, contributes both services and property. So we'll look at that a little later. Stock transferred. So as mentioned earlier, stock includes common and most preferred stock, does not include non-qualified preferred stock, which possesses many attributes of debt, doesn't include stock rights and stock warrants, and does not include corporate debt or security. So for example, if they also receive corporate bonds, it would be treated as boot. And the third requirement, which is control of the corporation. So control of the corporation, transferors must be in control immediately after exchange to qualify for non-taxable treatment. So to have control, the transferors must own at least 80% of the total combined voting power of all classes of stock entitled to vote, and at least 80% of the total number of shares of all other classes of stock. Control of the corporation, it should happen immediately after the transfer. Just keep in mind, it doesn't require simultaneous transfers if there's more than one transferor. The rights of parties should be outlined before the first transfer, and the transfers should occur as close together as possible. And after the control is achieved, it is not necessarily lost. So any stock that's received by shareholders is sold or given to persons who are not parties in the exchange. So any momentary control of the part of the transferor, it may not suffice if loss of control is required by, let's say, a pre-arranged agreement. So these are some things that you must keep in mind. Next, we have transfers for property and services. So as mentioned, it may result in the service provider being treated as a member of the control group. So as we pointed out, as it relates to property, Section 351 clearly defines that if you provide services, the stock that you receive is not considered property. Services are not considered property. However, there is an exception whenever a shareholder transfers both property and services, right? So whenever an individual contributes both services and property in exchange for corporate stock, they include in the taxable income the value of the stock received for services, but not the value of the stock received from the property, assuming that the property that was transferred, they essentially have control. So to be considered a member of the control group, the service provider should have transferred property having more than a relatively small value. So the regulations, the Internal Revenue Code, they don't define what that necessarily means, but the IRS has stated that the control group includes a person who contributes both property and services only if the value of the property equals or exceeds 10% of the value of the services provided. So if the value of the property transferred is less than this amount, the IRS is likely to treat the property contributed as having a relatively small value, and they would disregard it in applying the control test. But if they contribute 10% or more, then it would apply in Section 351. They would be considered eligible. So now we start to look at the basis to the shareholder, right? So these are one of the issues: basis, determination, and the related issues. So recall that Section 351, it postpones, it defers gains or losses until the transferor shareholder disposes of the stock. Simply stated, until they sell it. So the postponing of the shareholder's gain or loss, it has an effect on the basis of the stock received by the shareholder and the basis of the property received by the corporation. So this basis adjustment, it basically ensures that the corporation recognizes the gain or loss that's postponed under Section 351 when and if it decides to sell the contributed asset in a taxable transaction. So as it relates to the basis of the shareholder, their basis of stock, it is calculated as follows: the adjusted basis of the property transferred plus the gain recognized. You subtract any boot received, and this includes any liabilities transferred. You also subtract any adjustment for lost property if elected, and that equals the basis of stock. As it relates to the corporation, just as a stockholder's stock embeds deferred gain or loss into the stock basis, there's a similar carryover basis rule that exists for computing the basis of the corporation's property. So this rule provides that the property's basis to the corporation equals the basis in the hands of the transferor plus any gain recognized on the transfer by the transferor shareholder. So the corporation's basis in the property received would be calculated as follows: the adjusted basis of the property transferred plus any gain recognized by the transferor shareholder. And from there, you would subtract the adjustment for lost property if required, and that will equal the basis of property to the corporation. So here we have this example. We have property transferred has a fair market value of $150,000. And the basis is $100,000. So there we have a realized gain of $50,000. So the liabilities assumed by the corporation, these are some independent facts. So there's business purpose 1, there's a liability of $80,000. Business purpose 2, there's a liability of $120,000. And for no business purpose, a liability of $120,000 is assumed. So in this example, we look at the liability of $80,000. We factor in the basis of the transferred assets. There was no gain recognized by the shareholder, so therefore the basis to the corporation is $100,000. Next, we factor in the basis of the transferred assets, the gain recognized by the shareholder, and that increases the basis to the corporation. The same thing applies. We see that the liability was $120,000. The basis of the transferred assets were $100,000. The gain recognized by the shareholder is $50,000. Therefore, the basis to the corporation is $150,000. So the adjusted basis of transferred assets is $100,000. And when the liabilities are assumed by the corporation, we need to determine what is the basis in stock. So we consider the liability that was assumed, the basis in assets that were transferred. There was no gain recognized, so we add nothing. We subtract the liability that was transferred. And in the first scenario, the basis in stock is 20,000. In the next scenario, the liability assumed is 120,000. We start off with the basis in the assets transferred. We add the recognized gain, and from there we subtract the liability that was transferred. So the basis in stock for the second scenario is 0. For the last purpose, the last scenario, the liability was 120,000. The basis in the assets transferred 100,000 plus the gain recognized of 50,000 minus the liability transferred of 120,000. Therefore, there is a basis in stock of 30,000. All right. So these are just some really important things to keep in mind. The great thing, obviously, there's a formula that you can essentially refer to, but for the most part, you want to be able to understand. So that way, even as you are, working with clients who want to set up a corporation, you now have the opportunity to do some tax planning. So now one thing we need to account for is the basis adjustment for lost property, right? So essentially what happens is sometimes a taxpayer, they'll contribute a property with a built-in loss. So whenever a built-in loss property is contributed to a corporation, the aggregate basis in the property may have to be stepped down so that the basis does not exceed the fair market value of the property transferred. All right. So you might ask, so wait, what does that even mean? So when we hear the word aggregate, aggregate basically represents a whole formed by combining several elements, right? So simply stated, to collect or gather into a mass or whole. So let's say you are contributing cash, you're contributing a building, and you are also contributing equipment. You're contributing those 3 things. So the aggregate basis, the basis of all 3 items that you are contributing. And the reason why this is important is because it's necessary to prevent parties from obtaining double benefit from the losses involved. So when it comes to the step down basis, it's allocated among assets with built-in loss. And alternatively, if shareholder and corporation both elect, the basis reduction can be made to the shareholder's stock rather than to the corporation's property. And lastly, the built-in loss adjustment, it places loss with either the shareholder or the corporation, but not both. So corporate treatment when issuing stock for services. So a corporation's transfer of its stock for property, it's not a taxable exchange. A transfer of shares for services, also, it's not a taxable transaction to a corporation. But another issue arises. The corporation needs to figure out, hey, well, can we deduct as a business expense the fair market value of the stock that we issued in consideration for the services? Yes, it is allowed unless the services are a capital expenditure. All right. So that's the key thing to keep in mind. Here we have an example. If there's performance of management services, they may claim a compensation expense deduction under Section 162, and Section 162 states that a business may deduct all expenses that are ordinary and necessary in nature. If the services are categorized as a capital expenditure, so for example, legal expenses, organizing the corporation, they have to capitalize the amount as an organizational expenditure. The holding period for shareholders in the transferee corporation. So this is also important because when it's time to sell the item, we need to make sure that we know if it is short-term or if it is long-term. So in a Section 351 transfer, the shareholders holding period for stock in exchange for a capital asset or a Section 1231 property, it includes the holding period of the property transferred to the corporation. So what that basically means is the holding period of the property is tacked on to the holding period of the stock. But the holding period for stock received for any other property, so let's say cash or inventory, it begins on the day after the exchange. So just some key things to keep in mind. Then we have recapture consideration. So anytime there's a sale of an asset that is depreciable, And if there's a value that exceeds the basis, then it results in ordinary gain up to the accumulated depreciation deducted. So keep in mind, with depreciation, it is claimed as an expense, but unfortunately, when you sell the property, you have to account for all of the depreciation expense that was claimed. So in such case, the rest of the gain usually it's treated as a Section 1231 gain, but because Section 351 defers the gain when a shareholder contributes this depreciable property, then the depreciation recapture potential, it also transfers to the corporation. That is, so if there's any recapture potential associated with the property carried over to the corporation, the rule basically prevents taxpayers from converting ordinary income into Section 1231 gain by transferring the property to a controlled corporation. So again, with the Internal Revenue Code, they catch on to things, the savvy ways in which individuals are taking advantage of the tax law, and they put these rules in place to ensure that they are not being taken advantage of. Next, we have the assumption of liability. So it's not uncommon to form a corporation by transferring assets as well as liabilities of an unincorporated business. So absent a special rule, the party that enjoys the debt relief, they treat it as cash received equal to the debt relief. But without a provision to the contrary, the transfer of mortgaged property to a controlled corporation, it could trigger gain to the property transferor if the corporation takes over the mortgage. So having to pay the tax on this gain, it would discourage people from wanting to form corporations. So because of that, there's this special rule, Section 357A, and that basically provides that when a corporation assumes a liability in a Section 351 transaction, the liability is not boot received for gain recognition purposes. However, liabilities that are assumed by the corporation, they are treated as boot when it comes to determining the basis of the stock received by the shareholders. So as a result, the liabilities of the corporation assumes it does not trigger gain, but they do reduce the basis of the shareholders' stock. So it's something, very important to keep in mind. So again, in general, the assumption of a liability in a Section 351, it doesn't result in boot for gain recognition purposes. However, the basis of stock received, it is reduced by the amount of liabilities assumed by the corporation. Liabilities are not treated as boot for gain recognition unless liabilities incurred for no business purpose or it's a tax avoidance mechanism. So boot should be equal to the entire amount of liabilities. And in the event that liabilities are greater than the basis and assets transferred, the gain recognized is the excess of liabilities minus the basis. So again, Code 3057B, it provides that if the principal purpose of the assumption of the liabilities is to avoid tax, or if there's no real business purpose, then unfortunately, the liabilities are treated as boot for determining recognized gain. So again, of course, there's people who will want to take advantage, but the code is up to par with that. So therefore, that is why there needs to be a business purpose, and it cannot be put together, or the corporation cannot assume the liability simply to avoid taxes. So here we have an example of formation with liabilities. So we have this property transferred. The fair market value is $150,000. The basis is $100,000. Therefore, there's a gain of $50,000. So it uses the same fact pattern as we saw before. Business purpose 1, liability of $80,000. Business purpose 2, liability of $120,000, and no business purpose of $120,000. So for business purpose 1, the fair market value of the stock received is $70,000. The liabilities assumed are $80,000. So the amount realized, we essentially add the two, and that gives us a total amount realized of $150,000. We compare it to the basis of property transferred. There is a difference of $50,000. So therefore, there's a $50,000 gain recognized. Next, we see the business purpose 2. The fair market value of the stock received is $30,000. The liabilities assumed are $120,000. That gives us a total amount realized of $150,000 less the basis of property transferred. We have a gain loss recognized of $50,000. So the same applies
for no business purpose. But again, as we go to the next slide, it's important for us to realize that business purpose 1 and business purpose 2, obviously, as in the wording, there's a business purpose versus the last scenario where there's no business purpose with a gain or loss of 50,000. So the liabilities assumed by the corporation. For business purpose 1, there's no boot recognized, there's no gain recognized. And then for the business purpose 2, we essentially consider the fact that there's no boot, but we look at the gain realized and we claim the lesser of the two, the lesser of the gain realized or the lesser of the 50,000 realized. So here we see the liabilities assumed in comparison to the basis of the property transferred. So in such case, the gain realized is the lesser of the two. And then since there's no business purpose, we recognize the entire $120,000 as boot and the gain recognized of $50,000. So again, there's a lot of nuance as it relates to the formation of a capital, structure and organization of a corporation. So you want to make sure you understand nuances so you can advise clients correctly. So this brings us to Unit 2, the capital structure of a corporation. So shareholders can decide to form or expand a corporation using equity financing, debt financing, or a combination of the two. So it's very important to evaluate the relative tax and non-tax advantages of these two basic elements in the capital structure of a corporation that ultimately would help the corporation know how they need to finance their activities. So there's no gain or loss recognized by a corporation on receipt of money or property in exchange for its stock. This also applies to contribution of money or property through voluntary or required contributions to a corporation, even though no additional shares are issued. So whenever there's contributions by non-shareholders, so if the property is contributed to a corporation by, let's say, a civic group or a governmental entity to induce the corporation to locate in a particular community, such contributions are included in the corporation's gross income. However, if there's a municipality grant a tax abatement to a corporation for looking in the jurisdiction, the abatement is not taxable. Abatement is ignored when granted as it reduces future payments and related deductions for state and local taxes. Next, additional contributions by non-shareholders. For contributions in aid of construction or for capital expenditure by a non-shareholder, and this could be a customer or a potential customer, the corporation does recognize it as income. Further, if the property is transferred to a corporation by a non-shareholder in exchange for goods or services, the corporation must recognize income. Basis of property a shareholder transfers to a corporation as a capital contribution equals the shareholder's basis of the property of the corporation. However, the corporation must reduce the basis if the entire contribution has a built-in loss. So as we mentioned a little earlier, when there's a built-in loss, we need to consider the adjustment, which is governed by Section 357A. Next, we look at the debt in the capital structure. So there's various tax and non-tax characteristics of debt and equity that are relevant when developing the capital structure of a corporation. So the relative amounts of debt and equity, it's a strategic variable for a corporation. So advantages of debt. What might they be? We have three here. So the corporation pays interest to debt holder, and that interest that's paid is deductible by the corporation. The interest paid is taxable as ordinary income to the individual or corporate recipient. Loan repayments are not taxable to investors unless the repayments exceed the basement. As it relates to equity, the corporation pays dividends, which are not deductible, but it is taxable to individuals at low capital gain rates to the extent that the corporation has what's called earnings and profits. And earnings and profits, we will discuss that a bit more in detail. Reclassification of debt as equity, this is called the thin capitalization problem. So the tax and non-tax advantage of debt, they basically help to create incentives for taxpayers to want to classify equity as debt.
So it's unlikely that a bank would decide, okay, let's lend money to this corporation that has little or no shareholder investment. However, shareholders, they could make it look like they're lending money to the corporation instead of contributing equity just to obtain the tax advantages of debt. And this is what's called thin capitalization problem, in which a corporation, it appears to have artificially low equity and high debt. So the IRS, they may decide that, okay, or, this debt is really equity, and then they'll deny the tax advantages of debt financing. And if the debt has too many features of stock, principal and interest payments may be treated as non-deductible dividends. So some following factors are important in determining the characteristics in distinguishing between debt and equity. So debt instrument documentation, the debt terms, for example, what's the reasonable rate of interest and define the maturity date, the timeliness of repayment of debt, contingency of payment on earnings, subordination of debt to other liabilities, whether the debt and stock holdings are proportionate, the use of funds. Is it used to finance initial operations or to acquire capital assets? And lastly, what is the debt to equity ratio? So again, code 385 or section 385 gives the Internal Revenue Service the authority to classify an instrument as either wholly a debt or equity, or as part debt and part equity. So this is a flexible approach, and it's important because sometimes it's really difficult to determine whether an instrument is wholly stock or wholly debt. But the principles that we just mentioned above, they're relevant mainly for closely held corporations. Therefore, there are these characteristics to help to distinguish between the two. Next, we move on to chapter 3, or unit 3 rather, investor losses. So the tax law provides some special rules for recognizing gains and losses from investing in corporate stock and debt. So in this section, we describe the general rules for investor losses, and then we'll describe some of the special rules for losses. So stock and security losses, if stocks and bonds are capital assets, losses from worthlessness are the same in nature. Those are also capital losses. So the losses treated as occurring on the last day of the taxable year in which they became worthless, and there's no loss for the mere decline in value. So if the value increases and decreases through the year, there's no adjustment for such. If stocks and bonds are not capital assets, losses from worthlessness are ordinary losses. So, for example, if it is broker owned, sometimes an ordinary loss is allowed for the worthlessness of stock of affiliated companies. So it's very important to distinguish between business versus non-business bad debt. So in addition to worthlessness of stocks and bonds, the financial demise of a corporation can result in bad debt deductions to those who've extended credit to the corporation. So these deductions, they can either be business bad debts or non-business bad debts. So the distinction between the two is important for tax purposes. Why? Because for business bad debts, they result in ordinary losses, whereas for non-business bad debts, they result in short-term capital losses. So therefore, a business bad debt can create an increase or a net operating loss, but a non-business bad debt entity can only create or increase a capital loss. So if non-corporate person lends as an investment, the loss is non-business bad debt. And again, it's a short-term capital loss, and it's only deductible when it's fully worthless. So business versus non-business bad debts. If the corporation is a lender, then the loan is considered a business bad debt. Why? Because they are in the business of lending money. In such cases, treated as an ordinary loss deduction, the deduction allowed is for partial worthlessness, and all bad debts of corporate lender qualifies as business bad debts. Non-corporate lenders, rather, they qualify for business bad debt treatment if the loan is made in some capacity that qualifies as a trade or business, or the shareholder is in the business of lending money or of buying, promoting, and selling corporations. So now this brings us to section 1244. There is an exception to the capital loss treatment that generally results. So we have what's called Section 1244. And Section 1244 permits ordinary loss treatment for losses on the sale of worthlessness, of stock of so-called small business corporations. So essentially, by placing shareholders on a equal basis with proprietors and partners in terms of tax treatment of losses, this provision basically helps to remove the impediment to equity investments in small corporations. So, because this ordinary loss treatment avoids capital loss, because again, with an ordinary loss, you get to claim the full amount of the loss and write it off versus a capital loss, whereby it is limited to $3,000 per year. So, therefore, because this ordinary loss treatment avoids the capital loss limits that prevents deduction of losses, shareholders have nothing to lose and everything to gain if they comply with the rules of Section 1244 stock. So again, treatment of 1244 stock, ordinary loss treatment for loss on stock of small business corporation as defined, and the gain is still a capital gain. So some qualifications for Section 1244. The ordinary loss treatment for Section 1244 applies only to losses on the first 1 million of stock the corporation issues at its creation. If the corporation issues more than $1 million of stock, then the corporation designates which shares are going to qualify for Section 1244 treatment. The corporation measures the value of the stock on the date that it's issued and at its adjusted basis minus any liabilities that might have been assumed by the corporation. The fair market value of the property is not considered. So keep that in mind. So presumably that's because determining the fair market value is costly, right? And sometimes it could be difficult, especially for a small business. So just note that these rule means that stock qualifying for ordinary loss treatment does not lose the status if the stock that was issued passes the $1 million limit. So the annual loss limitations are as follows: $50,000 or $100,000 for spouses filing a joint tax return. So it's $50,000 for everyone other than married filing couples. And any remaining loss is a capital loss and it is carried forward. One key thing is that Section 1244 only applies to the original holder of Section 1244 stock. And this can be an individual, it could be a partnership. They qualify for the ordinary loss treatment. It has to be the original holder. If the stock is sold or donated, it loses the 1244 status. If Section 1244 stock is issued for property with basis, it must be greater than the fair market value. And this is for purposes of determining the ordinary loss. The stock basis is reduced to the fair market value on the date of the exchange. So we continue on to Unit 4. And with Unit 4, we discuss the gain from qualified small business stock. So to further encourage certain corporate small business formations, there's what's called Section 1202. And Section 1202 gives non-corporate shareholders special tax relief for gains that are recognized on the sale or exchange of stock that they acquire from a qualified small business corporation. So a qualified small business corporation, they issue qualified small business stock, and this is referred to as QSBS. And what this basically means is that the holder gets to exclude a portion of gain from the sale or exchange of such stock. The exclusion percentage varies depending on when the shareholder acquired a qualified small business stock. So stockholders exclude 100%, 75%, or 50%, again, dependent on when the stock was purchased. So one of the key things as well is that they must have held stock for more than 5 years and acquired stock as part of the original issue. The exclusion can be applied to the greater of 10 million, 10 times shareholders' aggregate adjusted basis of qualified stock disposed of during a taxable year. Exclusion percentage is 50, 75, or 100%, depending on when the qualified small business stock was acquired by the shareholder. So, for example, 100% of the gain is excluded for qualified stock acquired after September 27th, 2010, and qualified small business corporation. C corporation with gross assets not greater than 50 million on the date that the stock is issued, and it must be actively involved in a trade or business, and at least 80% of the corporate assets are used in the active conduct of one or more of qualified trade or business. So this brings us to Unit 5, tax planning. So qualifying under Section 351. Again, a lot of times clients, they will decide to, come and ask you questions before they even undertake something, because just about every transaction has tax implications, tax consequences. So much like with any provision in the tax law that affords special treatment, taxpayers, they need to consider whether or not they're going to qualify for the special treatment and whether or not they should take advantage of that treatment. So Code Section 351 provides one of those provisions that requires careful planning. So first and foremost, shareholders should ensure that the parties transferring property receive control of the corporation. The gain deferral requires a large contribution of assets than the new shareholders can afford in case of mature corporations. And according to the regulations, and existing shareholders' previously acquired shares do not count toward meeting the control test. So that's very important to keep in mind. The transferor's primary purpose is to qualify other transferors for Section 351 treatment, and the value of the new stock is relatively small compared to the already owned stock. So these are things to keep in mind. In some cases, they might want to avoid Section 351. So although Section 351, it benefits shareholders by deferring the gain, in some situations, shareholders benefit from avoiding Section 351. So this can occur if the transferors prefer to recognize gain at the time of the property transfer. One of the reasons being is because the shareholder might be in a lower tax bracket and that they have losses available to offset the gain. So in such case, the corporation will then have a fair market value basis in the transferred property at a low or no tax cost. Again, so it might benefit them. So a transferor who wants to recognize the loss, they have several alternatives. They can sell the property to the corporation for its stock. They can sell the property to the corporation for cash or other property, or they can transfer the property to the corporation in return for its debt or non-qualified stock. Next, we have selecting the assets and liabilities to transfer in a Section 351 transaction. So transfer of assets that produce passive income will attract personal holding company penalty tax when operating income is low. Leasing properties will allow the taxpayer to withdraw money from the corporation in a deductible form, and shareholders should consider the appropriate liabilities that should be transferred to the corporation, because again, once liabilities are transferred to the corporation, they need to be able to confirm that it is for a valid purpose and it's not just to avoid taxes. Next, we have the debt and capital structure. So another way to shift income to other taxpayers is by using corporate debt. So shareholders who also own corporate debt, they can give debt to family members in a lower tax bracket. And obviously, this works better for them. This gift helps to shift the interest income without losing control of the corporation. So earlier we mentioned some of the advantages and disadvantages of debt and equity. So to increase debt without incurring the thin capitalization problem, you get to consider the following tax planning strategies. They can preserve the formalities of the debt. If possible, they can have the corporation repay the debt when it comes due. Avoid provisions in the debt instrument that make the debt convertible to equity in the event of a default. Shareholders that hold the debt in proportion to their shareholding, they basically are telling Uncle Sam, hey, come and check this out, right? So it's basically like a red flag inviting the IRS to reclassify the debt as equity. However, proper tax planning can avoid the pro rata holding of debt. And you definitely want to try to keep the debt to equity ratio within reasonable proportions. In order to increase debt without incurring the thin capitalization problem, they can consider the following tax planning strategies. The nature of the business can affect what is an acceptable debt to equity ratio. So obviously the debt to equity ratio, it will depend on the industry, because obviously it varies based on the industry, right? How long the business might have been in operations, things of that nature. So a strategy to respond to an IRS assertion of thin capitalization based on book values could be used to recompute the debt equity ratio using the fair market values. This presumes that the corporation can credibly measure these values, but the result should better measure the economic debt equity ratio than using the book values, which may or may not be old. So double taxation presents a tax disadvantage for corporations, and this is us essentially comparing corporations to flow through entities. Double taxation, again, it presents a tax disadvantage for corporations. That's why we have what's called dividends received deduction when dividends are paid from one corporation to another. The Tax Cuts and Jobs Act of 2017 reduced the corporate tax rate to 21%. And it created a new 20% deduction under Section 199A for qualified business income, also referred to as QBI, of flow through entities. So this brings us to the end of chapter 4, corporations, organization, and capital structure. So now that this lesson has ended, you should have learned to explain the tax consequences of incorporating a business, identify the basis issues relevant to the shareholder and the corporation, determine the consequences when corporations assume shareholder liabilities, explain the tax aspects of the capital structure of a corporation, characterize the tax differences between debt, which is essentially bonds, and equity, which represents shares, stock. Determine the tax treatment of shareholder debt and stock gains and losses. And lastly, identify tax planning opportunities associated with organizing and financing the operations of a corporation.